Moderna is currently orchestrating a massive, totally unprecedented $54 billion pivot into individualized cancer treatments. But hiding right beneath the surface of this incredibly ambitious medical breakthrough is a ticking time bomb. We're talking about a massive $2.2 billion legal cash drain that threatens to completely derail their balance sheet right before they can cross the finish line. This is the ultimate race against time. What we're really looking at today is a company that is quite literally fighting for its financial survival while simultaneously trying to cure cancer.
And that right there is the central tension of this whole explainer. On one side of the ledger, you have a projected $54 billion unadjusted global peak sales opportunity in therapeutic oncology. I mean, that is a staggering number. But look right next to it. You have a very real, very imminent $2.25 billion potential cash drain tied to patent litigation that is actively bleeding their reserves. The market is entirely hyperfixated on the $54 billion promise. But, as we're going to see, if management can't handle this $2.25 billion reality, that oncology promise might not even matter.
It's actually fascinating to look at how the market reacted to this story recently. On August 19, 2026, the market was just absolutely blinded by euphoria. Following the announcement that their Phase 3 INTR Path 001 trial met its primary endpoints for high-risk cutaneous melanoma, Moderna's stock rocketed 177% in a single trading session. They closed at $174.38. In just one day, the market added roughly $40 billion to Moderna's market cap. It was this massive watershed moment that caused Wall Street analysts to frantically upgrade their price targets. It completely validated the mRNA platform's potential way beyond just respiratory viruses. But almost immediately, reality started to set back in. Literally the very next day, August 20th, we saw a classic buy the rumor, sell the news consolidation, and the stock pulled back over 18% to close at $142.69. And the real reason for that violent pullback? Well, that's exactly what we're going to dissect today.
So let's start by looking under the hood, at the engine driving that massive $54 billion number.
To survive, Moderna is desperately trying to pivot away from seasonal respiratory markets. They're trying to transition from a pandemic-era COVID-19 vaccine company into a highly diversified, multi-therapeutic mRNA platform. And the absolute crown jewel of this whole strategy is a drug called Intismeran, also known as V940 or mRNA-4157. This is an individualized neoantigen therapy being co-developed in a 50-50 profit-share partnership with Merck. When we talk about that Phase 3 data from August 19th that sent the stock to the moon, this is the drug. By combining this customized mRNA vaccine with Merck's blockbuster Keytruda, they significantly reduce the risk of recurrence or death in patients with completely resected stage 2B to 4 melanoma. Cutaneous melanoma all by itself represents an estimated annual commercial TAM of $1.4 billion to $2.5 billion. But here's why the market went crazy. This success provides the biological validation for their broader oncology platform. It essentially kicks the door wide open to trials in non-small cell lung cancer, renal cell carcinoma, and muscle-invasive bladder cancer. That's exactly where that massive $54 billion peak sales estimate comes from.
What's wild is that this isn't a drug you just pull off a pharmacy shelf. It requires a flawless, highly integrated operational workflow, which is actually what builds their economic moat. First, there's a surgical resection where a patient's unique tumor biopsy is taken. Second, that biopsy is shipped off, sequenced, and run through a custom neoantigen algorithm to identify up to 34 patient-specific mutational signatures. Third, an individualized mRNA payload is custom synthesized. And finally, it has to be delivered back to the clinical site within a highly regulated 6-week window. This creates incredibly deep operational integration with clinical oncology providers. It's really not something a competitor can easily replicate, especially when you factor in the sheer scale of Moderna's Norwood manufacturing facility. But, and this is a massive but, if there's a yield failure or even a slight processing delay in that 6-week window, the clinical treatment window could be missed entirely for that patient. So, the stakes for execution here are astronomically high.
But you can't fund this futuristic oncology engine if your core business is running out of gas. Which brings us to the conflict, the $2.2 billion cash drain. Look at the brutal reality of their legacy COVID business right now. We are looking at a total collapse. From peak pandemic revenues of $19.26 billion back in 2022, they've crashed down to a trailing 12-month revenue of just $1.94 billion today. That is a negative 34% compound annual growth rate. Standard earnings-based valuation metrics, you can basically throw them out the window because the company has become highly unprofitable as this core revenue has just completely evaporated.
We actually just saw this play out in real time during their latest Q2 2026 earnings, reported on July 31st.
Now, technically, they beat consensus revenue estimates. They reported $145 million against expectations of around $100 million. But when you lift the hood, net product sales still fell 18% year over year to just $94 million, weighed down heavily by weaker COVID-19 demand in the US and South America. Meanwhile, their GAAP net loss was a staggering $782 million for the quarter alone. And to make matters worse, during this earnings report, the stock actually fell over 5% because they slipped in a clinical setback for their norovirus vaccine candidate, which failed to meet early success criteria in a phase 3 interim analysis.
But the real financial terror isn't just the operating loss. It's the legal liabilities sitting on the balance sheet. Moderna recently settled a massive global patent dispute with Arbutus Biopharma and Genevant Sciences over the lipid nanoparticle technology they used in their Spikevax and mRESVIA vaccines. Let's do the math on that settlement. First, Moderna was required to make a $950 million upfront cash payment, which they literally just wired out in July 2026. That is going to severely impact their Q3 cash buffer. But it gets worse. There is another $1.3 billion contingent cliff hanging right over their heads. This one is tied to an appeal at the Federal Circuit regarding a Section 1498 government contractor immunity defense. If they lose that appeal, they owe up to an additional $1.3 billion. So that is a total potential cash drain of $2.25 billion, hitting exactly as their legacy revenues are scraping rock bottom. Which leads us to the ultimate question for investors. Can Moderna's pipeline scale fast enough to outrun this massive cash burn before the runway ends? And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed. We love looking at the actual numbers driving the narrative. So they had $6.9 billion in cash as of June 30th. But remember, that's before they wired out almost $1 billion in July for the lawsuit. Management is now projecting a year-end cash balance of just $4.7 to $5.2 billion, and they are relying on drawing down a credit facility. The runway is getting dangerously short, and they absolutely need to achieve cash break-even by 2028.
So, stepping back, how do we grade the underlying quality of this business today?
Let's objectively evaluate if Moderna is a high-quality business or a speculative gamble. We've synthesized this into a scorecard based on all the research. Look at the stark contrast here. On Growth Outlook, they score an impressive 8 out of 10. The FDA just approved their seasonal flu vaccine, Mflusiva, on August 5th for adults 50 and older. Plus, they have incredible momentum in oncology. But look down at profitability, a brutal 1 out of 10. In fiscal 2025, their net income margin was literally negative 145%. Financial health is sitting at a precarious 5 out of 10 because of those impending legal cliffs we just talked about. And regarding management alignment, CEO Stefan Bancel holds a solid 5.56% stake in the company, which is great. But his total compensation hit $19.93 million, and his cash bonus more than doubled, despite the company failing to meet its product sales goals and being wildly unprofitable. When you put it all together, you get a mediocre blended score of 5.2 out of 10. Essentially, this is a brilliant technology platform trapped inside a highly stressed business model.
Now, all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports exactly like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders for quality businesses built to compound for years, hidden gems for under-the-radar names with asymmetric upside, and dividend hunters for durable income with the fundamentals to back it up. They also have Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this screen. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
All right, let's look out to the future. Let's model a 5-year scenario analysis targeting the year 2031. Now, I need to be crystal clear before we get into the numbers. This is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios.
Using a reference share price of $142.69 from the August 20th close, we've modeled 3 probability-weighted outcomes. The spread here is absolutely massive, which perfectly illustrates this asymmetric risk profile. In our high case, we see a target of $350, representing a 145% total return. Our base case targets $195, which is a 36% return.
And our low case shows a devastating drop to $65 and negative 54% return. When we probability weight these, giving 50% to the base case and 25% to the extremes, we get a weighted price target of around $201.
To really understand those targets, we have to look at what actually has to happen operationally for each case. In the high case, we're assuming rapid multi-indication approvals for Intismeran across melanoma, lung, bladder, and renal cancers. Revenue scales all the way back up to $14.5 billion by 2031, margins expand to 25% due to those high-margin oncology royalties, and the market awards them a premium 9.66 times sales multiple. The base case assumes a successful launch in melanoma by early 2027 and a stabilization of the respiratory market, yielding $8.5 billion in revenue and a 15% net margin. But look closely at the low case. This assumes clinical delays for the cancer vaccines where the data ultimately fails to differentiate from just using Keytruda monotherapy. It also assumes they lose that Section 1498 patent appeal, resulting in that sudden $1.3 billion cash outflow. Revenue gets stranded at $2.5 billion, margins stay deeply negative, and massive shareholder dilution occurs just to keep the lights on, driving the stock all the way down to $65.
So what actually pushes us into that devastating low-case scenario? What are the hidden risks?
There are three critical threats investors absolutely must monitor closely here. First is execution. Because the personalized oncology vaccine requires that flawless 6-week custom synthesis loop, any manufacturing sequence delays or low yields at the Norwood facility would be catastrophic. It would instantly destroy commercial trust and clinical adoption. Second is competition in their legacy business. Moderna's RSV vaccine, MRNA, is lagging significantly behind the traditional protein-based giants right now. GSK's RXV already controls about 50% of the RSV market. If GSK and Pfizer continue to dominate the respiratory space, Moderna's baseline revenue is going to stagnate, heavily delaying their path to cash break-even. And finally, that legal risk. The early warning sign to watch for here will be the Federal Circuit oral arguments regarding their Section 1498 defense. Any adverse claims or noticeably negative questioning by the judges there could signal that the $1.3 billion penalty is imminent.
All right, let's bring this all together into the final verdict.
Here are the three most important takeaways. First, the landmark Phase 3 oncology validation is real. The August data proves that the mRNA platform can actually work in solid tumors, which massively expands their total addressable market. Second, this long-term promise is severely contrasted by terrifying near-term unprofitability. Their legacy COVID revenue has collapsed, and they are burning cash at a rapid pace. And third, this creates a deeply asymmetric risk profile. Much of the future oncology success is already priced into the stock at 27 times expected 2026 sales. The entire thesis here hinges on their ability to survive the $2.25 billion legal cash strain and the respiratory revenue trough before the cancer revenues can actually hit the balance sheet. Which happens first, the platform validating financially or the cash running out? That is the question you have to answer.
Is Moderna a visionary pioneer on the verge of curing cancer, or a cash-burning trap about to collapse under the weight of its own legal battles? Take a look at the data yourself. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.